be here tonight.
It would be my absolute pleasure. Ken and everybody, thank you for joining us tonight. My name is Amelia Leslie. I'm Client Service Coordinator with Epilepsy Southeastern Ontario. And thank you again, Ken, for this lovely opportunity this evening. And so I'd like to start off with a little bit of a statistic to give some context to the relevancy of our services here at Epilepsy Southeastern Ontario. 1 in 100 people can experience epilepsy, and 1 in 10 can have a seizure. So those numbers really reflect the significance of having community supports like ourselves. Epilepsy Southeastern Ontario, which I'll also refer to as ESEO in its shorter form, is one of 14 nonprofit epilepsy agencies across the province. We provide all free supports and non-medical supports to anyone, individuals or families, service providers, caregivers living in Southeastern Ontario. And we're located in Kingston, just up by the Kingston Centre, 920 Princess, if anyone is familiar with Kingston who's in attendance tonight. And we've been in the community for over 30 years now, so it's such a privilege to be here. Myself, excuse me, as Client Service Coordinator, I have a background in social work, and we've had a few name changes and service changes over the years, but we are currently providing a full array of services and supports and resources. So we are currently a staff of 2, myself as Client Service Coordinator and our Executive Director, Colin Slack, and he joined the team in this January. And so our services currently include one-to-one support, counseling, advocacy. We have our monthly group meetings that are held here in Kingston, community speakers nights, educational presentations, and referrals to other community services, as well as a dedicated transportation program called Emily's Fund. As a part of ESEO, we also provide different educational informational resources, which are at the foundational level of building a safe and supportive community for those living with epilepsy. Referrals are made easy. Anyone can simply call or email to connect with us. You can self-refer, and we can connect you to the services that fit your needs best. We also can receive referrals from your primary physicians, for example, with your consent, of course, to connect. Once we make contact, we have an interview, like an intake, to get to know each other and see how we can help. And so now that you know a little bit more about us, and that might have been a lot of information, you can always refer to our website at www.epilepsyresource.org, or give us a call or email or drop by. If you are local to the Ottawa area, I would say you should connect with your local office. Like I mentioned, we're one of 14 agencies across the province, and in Ottawa you have Epilepsy Ottawa there. So thank you, Ken, for having us tonight, and we look forward to this wonderful information.
Thanks, Amelia. I didn't realize there were that many epilepsy-related organizations or groups in Ontario.
Yeah. We're all independent, but similar with very common mission.
Yeah, that's very interesting. Well, I know I've been able to get people with epilepsy approved for the disability credit. It's not always easy, but it is certainly doable for anybody who's taking part with that particular perspective, you know. Interesting. Okay, well, I'll start. And I'll try to keep it to about an hour and a half, but at the end of that, there will certainly be lots of questions. I see we have 53 people in attendance, and we're already starting to get all the questions. I see that. Okay. Well, firstly, the PowerPoint slides that you see here. The first one shows the numbers. Let me move this around a bit. There we go. Okay, thanks. You can see the numbers here. And the short story is that 1 family in 10 in Ontario is the parent household of a child with special needs or disabilities. And the numbers are phenomenally staggering, actually, when you think about it. But the calculations are really quite simple. If you take the population of Ontario at 13.7 million, what StatsCan says is that you take that number and divide it by 3, and this tells you how many households there are, which you would intuitively sort of feel, oh, okay, 3 people, 2 parents, 1 child, this, 1 child, 2 kids, this sort of thing. So if you take 13.7 million people, and you can see here on the slide that divided by 3 is 4,566,000 households. And then if you look at the ODSP statistics, and I have lots of them of different breakdowns and sorts, but you can see here, if you look at all, can you see this, this cursor, Amelia? Can you see that going?
I can see a cursor at the bottom of the screen moving.
Okay, so it's working fine. So you'll see that there's all of these numbers, and these are the numbers of people who rent privately or are subsidized. So that's interesting. There's only 35,000 that are in subsidized units. There are 279,000. That's these 2 numbers put together that are renters. There are, in fact, 19,000 people who own their home. And there are 46,000 who are boarders, room and board. These are people that are living with family, children typically who are still with family. Could also be siblings living with their brother or their sister. And we'll come to this boarders number in a second. But you see here, that number, all of these numbers, total 362,000. Now, these are only people that are between 18 and 65. So it doesn't include the numbers under 18 or over 65. Because if you're over 65, you're just a senior citizen. You're not an ODSP, you get old age security and GIS. And if you're under 18, well, then again, you're not an ODSP and you're not non-existent. You're just not on ODSP. So those 2 groups, under 18 and over 65, those are another third. So if you have about 362,000 people, 18 to 65, you have something like another 100,000 at least who aren't in these numbers. So if you had 462,000 compared to 4,566,000, you can see that equates to roughly 1 household in 10. So it's not rocket science, it's just phenomenal. So what this means is that in any group, any organization that you're involved with, whether it's a church group or a choir or a sports group or any other kind of group, 1 household in 10, 1 in 10 basically of the people that are in this group are the parent household of a child with special needs. And I ran into a little white car, early in January last year. I was going down the road and this car stopped quickly in the middle of the road, and unfortunately I slid and hit it. So I was pulled over to the side and talking to the guy, the driver, and his wife went over to take a look at my car, and she came back and she said, "Are you Ken Pope?" Because of course I have vanity plates that say K Pope Law. And so she came back and said, "Are you Ken Pope?" I said, "Yes, I am." "You're the lawyer that deals with special needs?" I said, "Yes, that's me." "Oh, we're supposed to call you. we have a child with special needs." So later I offered them a special deal because of the inconvenience. But it's amazing. So that said, you can see this 46,000 number. Now those are all the kids 18 and older living at home with family. And these are the benefits that people on ODSP receive. They get monthly $896 or $1169. And we're regularly able to increase these benefits to $1169 because the 46,000 all get the 896. They're room and board. So what we do is we set up a lease arrangement between the parent and the child pays rent to the parents. The parents don't declare this as rent. They're not supposed to declare this as rent because they're not in pursuit of profit. But it's a $273 a month increase. So one of the very first things that we do is we check and we try to find the 13% of people who are living at home and try to help them get more benefits. Whatever other supplementary benefits they may have, such as $100 for working or a special diet or those things, those are all remain in place. They're just on top of 1169 instead of 896. The change that happened September 1st of 2017, that I don't think the word is out yet, is that the voluntary gift rule changed from 6,000 over 12 months to 10,000 over 12 months. So a child could now receive from any source, from family or their own resources, modest inheritances, for example. They could receive $800 a month, $9,600 a year, over 12 months rather, without affecting ODSP, which is good. It's now easier for parents and Henson trusts to give more to kids with special needs. The other small changes are that, excuse me, the asset test went from 5,000, thank you, went from 5,000 to 40,000 per individual. And if you have a spouse, it's in fact slightly more. It's now 40,000 plus 10,000 for the spouse. I'm not sure what number of people on ODSP have spouses, but that applies to some. And the other change, August 1st of 2017, was it used to be that if you were injured, personal injury, motor vehicle, that the first 100,000 of pain and suffering settlement, the tort settlement, is exempt. But now the full pain and suffering tort element is exempt, whatever it is, 1.3 million, it's all exempt. It doesn't, on the face of it, fully deal with the statutory accident benefit element, which is supposed to pay for transportation and medical care and housekeeping and physiotherapy and all those things, which can certainly add up easily. In lots of cases, it's $600,000. That itself is not explicitly exempt, but working with, for example, the Ontario Trial Lawyers Association, the people that get people settlements on a contingent basis, they can now get the maximum tort settlement. And as long as the statutory accident benefit element of it doesn't include income replacement or non-earner benefits, which of course would affect ODSP benefits, as long as it doesn't affect that or include that, then we can normally get the SAB, the statutory accident benefits, exempted as well. So this is just a quick slide about the increase. And as I say, the way we do this is with a lease document, and we submit it to the local ODSP office, wherever it is in the province, with our letterhead, which I think has a facilitating effect. And we do a story on the child. And if the child can shop and cook to some extent, often with support, but lots of times completely on their own, if they can shop and cook, the odds are extremely good that we can get these benefits increased. And we're prepared to do this on a contingent basis. So if we succeed, then of course we have fees, but if we don't, there is no fee. A small thing is that if you know anyone who's receiving CPP disability benefits, medically they are approved or will be approved automatically for ODSP because the test is higher. For CPP disability, it's that you can't work at all. Now it's true, you can make about $5,000 a year, but in essence that you can't work at all. Whereas for ODSP, the top line test is that you can't function in a competitive workplace. It's not that you can't work. And of course, if you do work, you get an extra $100 a month. That's just how it is. So instead of $11.69, you get $12.69. The first 200 that you make is exempt. And then for every gross dollar after that, you lose 50 cents. Plus, the fact is that working is social, working is good. And my experience is that my clients' kids show up on time, they work hard, they do their best. And I also have found over the last few years, decade, that where prior to the last decade, there was quite an emphasis on sheltered workshops and accommodating employment situations. There are lots of cases now where, partly because it's harder to get good assistance, good labor, but also because for example, the functions, the steps in a factory have been broken down and automated to such an extent that that a person who does have some disabilities can work in those environments because it's been broken down into small steps, and they're paid the same as anybody else, which I think is great. The next thing we do to try to put money into people's pockets is to see whether they're using the disability tax credit and the caregiver credit. You'd be surprised how many people are not using the disability tax credit. The disability credit is the child's credit transferred to a tax-paying parent or sibling, typically. Because people on ODSP, of course, ODSP is not taxable. So the child may qualify if they are markedly restricted or take substantially longer or can't set and keep goals, or of course have any of the obvious physical disabilities. They're in a wheelchair. They can't walk as fast as you and me. Not that I'm that fast, but we get a lot of people approved. And what we have to do also is we have to lift our eyes up, because if you only focus on the child and you ignore the parents or the grandparents sometimes, because often grandparents are very supportive, you have to lift your eyes up and look at the parents and the grandparents. Well, what about them? Would they qualify for the disability credit? I had a nice woman come to see me a few weeks back, and she was supposed to arrive for 2, but she couldn't find the office, and she called a couple times and we gave her some guidance, and so about 20 after 2 she arrived, and we talked. Usually we talk for about an hour, and about 1 client in 13 ever sees my office. All of the other ones don't come to town. We serve them remotely, which they see as an advantage because they don't have to drive, whether it's to drive to downtown Toronto and find parking and go to some lawyer's fancy office, or to drive from Cap to Sudbury, or wherever you have to usually go to get the kind of benefits and supports that you normally need for your child. So the remote assistance arrangement works very, very well. But only about 1 in 13, of course, live in Ottawa. So they might come here. They might come to the office. But what we, as I say, to take a step back, what we do is we identify whether they're using the disability credit, should it be applied, have they been approved for it. And I would guess that that about half of my clients' kids would qualify for the disability credit, and that about a quarter are not using it. A quarter of the total. And so what we do very regularly is we recapture the caregiver. The recapture is presently about $18,000. And for the, sorry, that's the disability credit, sorry. It's about $18,000. And the caregiver credit is about $8,000. And up until the end of 2016, the caregiver credit, which reduces taxes by about $1,000 a year, changed over the last 10 years, but presently reduces taxes by about $1,000 a year. Up until the end of 2016, the only people who could use this were the parent caregivers for the 46,000 kids who lived with them. So of the 365,000 people, only 46,000 families would be able to use the caregiver credit. So in 2017, the rule was changed and the reside with criteria was removed. So what this means is that as of 2017, I think that basically all of the 365,000 families could use the caregiver credit. And what this means is that instead of just the 46,000 families saving $1,000 a year, we would have virtually 365,000 saving $1,000 a year as of 2017. Now the problem is that most families don't know this. So we regularly put this back in place every day, all day. And it's very gratifying because what it is, it's a tax credit that should be used, is not used. And when you put it back in place, people save retroactive amounts. It wouldn't be unusual to find out that for 10 years, they could have used it, both when the child lived with them and also for the last 2 years when they didn't. And the total recapture is approximately $8,000. Well, this is good. Karen, do we have any questions? How are we doing with questions?
We have 3 questions right now. One question is, how is income from the Henson Trust treated? If one is on ODSP, doesn't the income from the trust count as income and lower the amount of ODSP received?
No, it doesn't. No, all payments, disbursements from an RDSP are exempt for all social benefit purposes. So this would be both ODSP plus all of the other provincial equivalents, AISH in Alberta. Everybody's got an acronym. And also when the child turns 65, because of course the payments in a lot of cases will commence when the child is 60. They're not kids anymore, obviously. And the parents may well be deceased, which we'll discuss that when we get to guardianship. But when they start to receive payments, whenever that is, they're all exempt. And so, for example, if they're over 65 and they're receiving guaranteed income supplements, which otherwise would be impacted for every dollar that is received, you'd lose 50 cents of GIS. Well, only the true income, sorry, that's not, let me take a step back. I'm sorry. None of the income from the RDSP affects social benefits. So it's basically treated like a social benefit. Now, it is true that for income tax purposes, 90% of the payments from the RDSP are income, because only the 10%, which reflects the $1,500 a year contribution, is simply the return of capital. So of the payments made from the RDSPs, approximately 10% will not be taxable or not income. And then the other component will be income, but it won't affect social benefits, ODSP, GIS, any of those things. And in fact, it won't be taxable because the payments that come from the RDSP, and we'll get into this, will, in my experience, using calculations and presumptions, they'll be $8,000 to $12,000 a year for a 23-year period paid from the RDSP to the beneficiary. But of course, if it pays $8,000 to $12,000, and if it was all income, well, the individuals by definition have a personal credit of $12,000, plus by definition, they have a disability credit of $8,400. So obviously, if the maximum payment from an RDSP were $12,000 a year, or up to $20,000 if they've been super funded, and I do have some clients who have super funded their RDSPs, and they have put up to $200,000 into it. Well, obviously that's going to pay more, but you'd have to have $20,000 of income component. And of course, if you super funded the RDSP with $200,000, $30,000 to get the grants and bonds, and $170,000 in addition, well, when that money's paid out, that's not income. That's simply a return of capital. So all you're going to have is the roughly $8,000 to $12,000 of income component, which will then not be taxed because the beneficiary has $20,000 of tax credits. So it's not going to have any effect on anybody. It will only be an improvement. Okay, so caregiver credit. It's a credit used by caregivers, which would mean the parents of or siblings of, and it can be backfiled for up to 10 years. So if you backfiled it, the person would have to be, since you have to be 18 to qualify, the person would have to be 28 or older to backfile for the 10 years. And to check your own returns, they changed the return line in 2017. It's now line 307. So check 307 for 2017 or 2018, and that'll tell you whether you're using the caregiver credit. In prior years, it was line 315. So for 2016 and back, it was line 315. And if you then check line 306, because there's often a scenario where people use 306, which is the adult dependent credit, and this conflicts with the caregiver credit. I won't go into all the details, but if you're not using it, you're not using it, so we should talk. And if you are using it and also using 306, we should talk again. Are there any more questions?
I have one here. It's regarding a tax credit.
Yeah.
They helped their sister and was told that they couldn't claim the credit due to her being in a nursing home. Is this true? Also, due to her income being higher, it also didn't apply to me due to the income test. Is this true? Is there an income test, and can I transfer the credit to myself?
Well, there's two things that are lining up here that are not helping. One is the person is in a nursing home, and if attendant care exceeds $12,000 a year, which it will, then you can't use the disability credit. You can only use the disability credit if attendant care is less than $10,000. If it's $9,999, you can also use the disability credit of $8,400. If it's $10,001, you can't. And then if the person has a $50,000 income, if this is taxable income, they have to use the disability credit first. And well, all attendant medical expenses, whatever credits may be available, they have to use them first. Now, if there may be an angle that could be used, so I'd invite this person, Brenda. And do people know they can be anonymous here? Is this, yeah, I think it must have been, to remain anonymous, click the anonymous option, okay? As you can see on the bottom of the slide. But otherwise, my experience is people don't mind their names being shown. So if the person who has all of these attendant care expenses can't use it, because they can't, that doesn't necessarily mean that it can't be transferred to the sister. Now, I'd have to know more facts about this particular thing. And Brenda, I think we've spoken before. Now, once a person is approved for the disability credit, they can then have a registered disability savings plan. And the short story is that if you put $1,500 a year into it, the federal government will put $3,500 of grants and a $1,000 bond. You get the $1,000 bond even if you make no contribution, if your income is less than $24,000, which of course on ODSP it is. And also the comment I make is that some people set up the RDSPs for their children before they're 18, which is fine. But when they turn 18, the child will get the maximum grants and bonds. And over the following 20 years, they'll get all of the grants and bonds. Whereas prior to age 18, the grants and bonds are generally disqualified by the household income of the parents, because the household income is too high. And if the household income is greater than $94,000, then if the maximum that they get, if they no longer get $3,500 if they contribute $1,500, only the child would get that. They only get $1,000 for $1,000. So my usual advice is set up the RDSP, put $100 into it, get yourself on the mailing list, and then wait till the child turns 18 and then start to contribute. And that's also partly because my experience is that if you have a household, you have a couple, and they have 2 children, and youngest is a boy, he happens to have autism, he's 8 or younger, and they're paying, 30 to 80 grand a year for ABA therapy. Well, you've got a place for that $1,000. And if you wait until the child is 18 and they're receiving ODSP, they're getting $11.69 a month, all of a sudden it makes it a lot easier to contribute to the RDSP. Any questions about that?
Not at this moment.
Okay. I see there's a question over here. My son has the disability credit. I have not claimed the caregiver credit because he doesn't live with me. Okay. Well, that was true until 2016. So you could use it, but I am on CPP disability myself. So that means that the person on CPP disability, CPP is potentially taxable, but it's always less than the personal tax credit, just because the maximum is about $1,000 a month, and the personal credit is 10 to 12,000. So you don't have enough taxable income to make use of that credit. But you could, be creative and look around and find somebody else. Okay, next slide. And what I'd like to do to explain the scope of these RDSPs. If you start when the child's 18, you contribute $1,500 a year, you get $4,500, $3,500 grant, $1,000 bond. So commencing at age 18, you do this for 20 years, you contribute $1,500 for 20 years, and you contribute $30,000, and the government contributes $4,500 times 20, that's 90. So now that's 120. Well, if it was properly invested at, let's say, 5%, which is perfectly reasonable, at the end of the 20 years, all contributions plus growth are approximately $200,000, as you can see here. Now that's a lot of money. So now the child's 38 and has $200,000, but they can't withdraw any of it. And we've just this year started to get these questions about, can I withdraw it? Can I use part of it to buy a house? And, I don't have much money. Can I take part of it back? And, these sorts of things. Well, no, you can't, because it's a last in, first out. And as long as the 10-year vesting period has not ended, so such that all of the grants and bonds are vested, if you take money out, you lose grants and bonds. So there's no withdrawal really for 30 years. So now the child's 48. And you could at that point request that the formula be invoked, and the child would then receive approximately, let's say, $8,000 a year for 23 years. And there's a formula for this. But I suspect that if the child is 48, that the parents are going to be, let's say, 78, 82, not dead, which is good, right? And so they're going to wait. They're going to continue to help provide for the kid. And then it won't be until after the parents are deceased, and more likely when the child is 60. And if it's at end of 20 years, at age 38, 200,000. At age 48, when it's vested, it's 300,000. And if you were to wait until the child's 60, it's 400,000. And that's where you'll get into the $12,000 a year, according to the formula, which is interesting. Any questions about that?
Yes, we do. We have, where do we have to go to apply for the RDSP? At my bank, CIBC?
Well, you could certainly go to a bank, and there's nothing incorrect about going to a bank. But I'll tell you my experience, and that is that with the banks, they really don't promote it. And in order to set them up, you normally have to call a call center. You can't just walk into the bank and get one like a GIC. And in my experience, the banks don't provide investment advice the way other organizations, such as financial advisors with, for example, Investors Group, or any other advisors group that, for example, would place these for you with McKinsey Financial. Those advisors, they're in the business of giving you investment advice and coming to see you at least once a year and trying to sell you life insurance and, trying to maintain a relationship with you, which is good. I'm completely in favor with that. The fact that a person might help you to get life insurance if you think it's something useful, and by the way, might get a commission, more power to them, as long as they're serving you well. And as well with the banks, there's this conflict of interest, vested conflict of interest. An advisor gets more clients if he does well for his existing clients, and then they tell others. So if a financial advisor helps you to do well, protect your money, get a good return, all those things, it helps him to build his business. Whereas with the bank, the less that they pay you on the RDSP, the better the spread they get when they put that money out for other investments. So for example, I had a mom come to see me. This one happened to be maybe 3 years ago now, but it's just a common anecdote. So she came to see me, and we're sitting at the boardroom table, and she has a daughter with disabilities. And she had set up the RDSP, bang, back December 2008, right out the gate, right? And she'd made all the contributions. And people get blown away by the fact that they put in $4,500, $1,500, and they get $4,500. And they miss the fact that inflation erodes this at 2% every year, roughly. So I always ask people to send me or give me a copy of the RDSP statement. And I looked at it. And since inception, since it was opened, she had earned 0.5%. And I looked at another one must have been July last year, because it was a 6-month statement. And it wasn't fully funded. It only had about $42,000 in it. So it didn't have all the contributions and grants, and well, it had all the bonds, but didn't have all the grants. And in the 6 months of that year, it had earned $2.64 on $42,000. So of course I looked at the statement, and it was invested, sort of. It was in a money market fund. Now, a money market fund is basically cash. It's money sitting, waiting to be invested. And again, it was with a bank, and it just sat there. And on the other hand, I had a client who was dealing with TD Wealth, TD Direct, and she was supposed to be making her own investments. Now, TD does have the broadest options. For example, if you wanted to have an RDSP with Bell stock, at TD you could do this, TD Direct, TD Wealth. But the whole point of TD Direct is that you don't have an advisor. You're supposed to be making your own decisions. And so she needed an advisor. And she was complaining that she was getting no advice. So we moved the RDSP to another institution, one of the investors groups, I think. And she's fine from there. But this is very unfortunate, and it's been going on for 10 years. So my advice would be, don't do it with the bank, although you could certainly set it up and then move it. But I would recommend that you deal with a proper financial advisor and get proper investment advice. Now, what advice can you give on opening an RDSP for my sister who's 56? Well, the first advice, of course, is the grants and bonds end at age 49. If you, for some reason, wanted to put the money into an RDSP for various reasons, well, you could, up until she's 59. But it would really just be a place to park it. So here's the grants grants and bonds are only contributed until age 49, but anyone can contribute to the plan until the end of the year the beneficiary turns age 59. So you could use it, for example, to shelter gifts. Perhaps you've won the lottery. Someone gives you money. You receive a small inheritance. Now, it's only useful, actually, if you're over 49, because if you're under 49, then there are grants and bonds, and you'll get some grants and bonds. So then if you try to withdraw money for real legitimate purposes, you lose grants and bonds. And here's another one from Dennis. I'm a 67-year-old senior with epilepsy. Hello, Dennis. I've never been able to get the government to accept my disability for a tax credit. Yes, that happens a lot. However, if I could, is it worth my while at my age to consider an RDSP? No, it's not, because you're too old. You couldn't contribute to it. But if you have money that's earning income at age 67, you're no longer on ODSP, you're on old age security and GIS. If you happen to have money that's earning income, you might want to stick it into a TFSA up to $63,500, because the income you're earning on your savings, if you have them, every dollar of savings, of income, offsets 50 cents of your GIS. That's basically a 50% tax. But if you have it in a TFSA, at least the income on that lump of money, $63,500 plus $6,000 more each year, is not offset against GIS. All right. Are there any final questions about RDSPs and disability credits and so on?
I don't see anything about RDSP. Oh, wait. Is any recommendation on contingency planning for living arrangement with children with autism? She's high functioning, and we have a will and RDSP in place.
Well, it sounds like a lot of this is covered then. If you have a will with the Henson Trust, that's the first element. And then an RDSP is excellent. The RDSP, of course, is the property of the child. There's a common misconception that it falls into the trust, the Henson Trust. But of course it doesn't, because it belongs to the child, the beneficiary. It's only the assets, the estate of the parents, that falls into the Henson Trust when they pass on. Sounds like you've got most of this taken care of. Yeah, it sounds like it. You could check to see if you have passport funding to help with respite for the parents. That's a useful thing, passport funding. And then the only other factors is what we're going to come up to now. So you have a daughter who's high functioning, which is great, and she has autism. So would she qualify to, is she competent to sign powers of attorney for property and personal care? Because if she is, then you should have powers of attorney from your child. She's an adult. Someone is going to say, oh, I can't tell you that because, you know, it's private. So you need powers of attorney for property and personal care. And then the bigger thing is she actually able to manage the investment and ultimately the disbursement from the RDSP? The reason you have the Henson Trust is partly to protect ODSP benefits from an inheritance disqualifying them, but also to have a trustee or trustees to manage the money, invest the money, disperse the money, because it's probably better that there be a trustee rather than the child doing this themselves. So there's those two factors. So, like, for example, if the child was 66 and not on ODSP, would you still need trustees? Probably. But then what happens is, if the parents pass on, if they are the account holders for the RDSP, and if the child could be the account holder. They're competent enough, but perhaps not the best choice. Well, then there should be powers of attorney so that the attorneys for property, the legal representative for the daughter, so that they can be the account holders, because otherwise it's only the parents, and the parents are deceased. So who's going to manage this? Who's going to oversee the payments from it? And that could be done with a high-functioning daughter. Using powers of attorney for property. Now, we have lots of clients whose children are not competent. It's clear they're not. And if they are marginally competent, and if during the parent's lifetime, powers of attorney will be sufficient because people, doctors, institutions, you know, the child being sight unseen, if they're prepared to hang their hat on this, powers of attorney, well, that's the cheapest thing. But you'll find that after the parents are gone, that the capacity of the daughter will be more often challenged by banks, hospitals, doctors. So if the daughter is competent to sign powers of attorney, well, then that problem is dealt with. But if they're not, then you should consider a legal guardianship. And it's unfortunate that there are additional costs involved in this process. But what it does do is it plans for the transition from the parent managing these affairs to them being managed by perhaps siblings of the child, perhaps other family members, perhaps some professional. And that would require legal guardianship. And it also keeps you away from the slippery slope of the child being found not competent by some doctor, such as if the child has mental health issues and happens to have occasions where they wind up at the mental hospital at Royal Ottawa, for example. They could easily at that point not be competent. They're not incompetent in the sense, but their mental illness affects their competence. They're not just quirky, they're not capable. And they're found not capable by a doctor. And then the public guardian and trustee steps in and becomes their statutory guardian. Well, that's not the best choice. So the transition from the parents to the legal representatives, the guardians of person and property, that's a court application process. There's legal fees, there's 2 capacity assessments. They're about $1,200 each. There's another $500 to file with the court and get the public guardian to comment on the application. And I think it's next month that we're doing a more specialized, focused webcast on this topic. So you'll get notice. Anybody who is registered will get notice of the upcoming power of attorney and legal guardianship webcast that we're going to do with a capacity assessor and myself and one of my legal staff that does the guardianships. And we're looking for one other party to take part. I think I'll invite the fellow who's the executive director of Community Living Northumberland to see, because what happens is the child turns 65, parents are deceased, child turns 65. You need a legal representative to manage the RDSP, which is now $400,000. You need somebody to apply for and administer old age security and guaranteed income supplements. Now, you can get the doctor at the group home to fill out the form for OAS-GIS, but then the payments commence, and they're made payable to the child. And typically, ODSP is good with making the check for ODSP payable to the group home, for example. Christian Horizons, Community Living, some Oasis group, Carrie's Place. But now these checks are made payable to the child. Well, what do? Who has authority? Where do you deposit them? How do you do this? Well, you need legal guardianship. And as you'll see when we get there in a moment, there is also an adult dependent survivor pension for children of teachers, OMERS, OPG pensioners, statutory pensions, provincial statutory, which are half of the original pension. So if you're a teacher and you have an adult dependent child, and you retire and then you die, and your pension was $60,000, well, your child is going to get $30,000, which will of course offset ODSP. But competency-wise, are they competent to apply for the pension and to administer it? Or do you need a legal guardian? So let's see if we can find those. Pensions for adult dependent children. Eligible pension plans. Provincial statutory adult dependent survivor pensions. Children of teachers, municipal employees, hydro workers, power generators, Bruce Nuclear, for example. So if you're a teacher, you have a $60,000 pension, you die, and your child is, for example, just for simplicity, is at home with you, well, then they would qualify for $30,000 of your $60,000 pension. But can they apply for it and can they administer it? And what about OAS-GIS? And what about their RDSP? So here you have a child who's going to get a $30,000 pension. They've got a $300,000 to $400,000 RDSP, and they have OAS-GIS of $18,000 a year instead of ODSP. Who's going to administer this for them? Let's take a question. You see anything interesting, Karen?
Yeah, I do. I have someone here has a 28-year-old daughter with epilepsy, severe depression, and 24/7 migraines. She's of normal intelligence, but she does not meet the CRA criteria for disability. However, she cannot earn a living and has always lived at home. We have been told that she doesn't qualify for a Henson trust, and we have set up a trust in our will. Would we be able to set her up an RDSP?
Well, I think firstly, this person has been given a lot of bogus information. I mean, it's easy to say no, and at most entry-level positions, especially dealing with bureaucrats, that's their job, is to say no, right? They don't have authority to say yes, and they see their function as saying no. Anyway, that's my rant for the day. So I have a 28-year-old daughter with epilepsy, severe depression, 24/7 migraines. Now, would you say that this is someone who can function in a competitive workplace? No, because the mother has already said she's of normal intelligence and does not meet the CRA criteria for disability. She cannot earn a living, so obviously she can't function in a competitive workplace, and lives at home. Well, I have some friends who have a daughter who's in a similar situation, and we got her approved for the disability tax credit, and we're now going to get her approved for ODSP. And because she's approved for the disability credit, she can have an RDSP. So that's the solution here. So we need to get this girl onto ODSP because she can't function in a competitive workplace. We need to get her also approved for the disability tax credit. And we would normally use the same doctor for these two functions. And the test for the disability tax credit is the activities of daily living. And what I would look at, for example, is can she set and keep goals? And it's not that she wouldn't want to set and keep goals. It's that she might want to set them, but can she keep them? Like, does she spend most of a day, on certain days especially, in bed, in a dark room? Either because of depression, or because of the migraines, or the depression because of the migraines, and the epilepsy. Like, for example, I think we could probably get her approved just based on the depression and depression and migraines. But because of the epilepsy, her activities of daily living are markedly restricted. For example, I have a client, a mom, and she has a daughter with epilepsy. And, you know, you try to minimize these things, you try to accommodate them, you try to make the best of them. And a lot of these kids are very brave and work hard and deal with, you know, a fortitude that many of us just do not have. simply to survive every goddamn day. So what happens is this girl lives with her mother, and they have sort of safe areas set up in the homes in case she has a seizure. And I have other clients who they wear helmets all the time, and they spend most of their time in areas where things are padded and the sharp corners of things are covered. Or a client down outside of Cambridge, where he can't have a bath himself alone without monitoring because he might have a seizure and drown. Well, I think that that's a marked restriction in the activities of daily living. And going back to the story I started with, the daughter can do all sorts of normal things. She can take the bus, she can take the train, you know, she can get places. But before she leaves, she has to tell her mother where she's going. And she has to take her phone with her. And she has to tell her mother when she gets there safely. And she has to have a note with her so that if she has a seizure well en route, that when she wakes up, she can tell, because of course there's a plasticity in the brain after this, right? There's, you have to have notes as to, you know, where she is and where she's going and where her mother is, because of course she'll be disoriented when she first comes out of it. Well, you know, I think that if that is your daily routine, that you are markedly restricted in the activities of daily living. And of course, we were successful in getting her approved. So that all of the things you're being told here are simply incorrect. Which frankly, with all due respect, that's the most gratifying part of these webcasts that we do. When people come to me and they say, oh, I've been told this, I've been told that, and they're in despair. And all you have to do is explain the realities of what can be done and what should be done. All of a sudden, people have hope. Okay. It's 8 o'clock, so we've been talking for 8:04. So we've been talking for approximately an hour. Are there any good questions for us, Karen?
Most of them right now are about Henson Trust and the reducing of the ODSP. So I'm just going to wait to touch base on Henson Trust, if that's okay.
I'm just going to speak back to Chad's session here. Thanks, Chad. I appreciate it. No, federal employees are not included in the pension arrangements. Sorry about that. And also OPSU, not all provincial pensions are included. Some private pensions do have adult dependent survivor pensions, not a lot, but some. Aviva Insurance, Bank of Nova Scotia, but those are typically in the scenario where, and I invite everyone to check with their particular pension plan to see if there is an adult dependent survivor pension after your spouse dies, and also if your spouse predeceases you. So for example, suppose the mom's a teacher, the husband's got an OPSU pension, so when he dies, his surviving spouse gets some percentage of his OPSU pension, and then the mom who's the teacher, then she dies, and the son or daughter, for example, lives with her, and so clearly is dependent on her. Well, this would allow that child to get half of mom's pension. There wouldn't be a derivative portion of the OPSU from the dad. So, but with Bank of Nova Scotia, Aviva Insurance, and others, there is a pension for a surviving spouse. But if the spouse predeceases or is divorced or has, there's not a surviving spouse in the picture, well, there is a pension for some surviving adult dependent, which could then become the child. And also, if you're checking on this with your human resources pension people, don't just believe the first thing you hear. Don't get the answer in verbally. Write and request a written response, and then see what happens. And if you happen to be a teacher or OMERS employee or OPG pension hydro, my experience is that most of the pensioners, most of the potential pensioners, don't realize that there's an adult dependent survivor pension for the child. And especially in the case of teachers, lots of teachers marry teachers. So you have a double pension, and you wind up with your child receiving basically a full pension, indexed. Now, from an estate planning perspective, this is big.
Ken, one more question on that with the pensions. Question here, my brother's retired teacher and was never married. Would his pension apply to me when he passes?
Not in my experience, but I don't see why we couldn't push the envelope if we could show that the brother is an adult dependent survivor. There is certainly a pension for somebody. We know that there's a pension for a spouse. We know that there's a pension for a child. Well, let's be creative. Let's see if we can push the adult dependent survivor, especially if the brothers lived together and never married. And the teacher brother was never married. I would recommend we give this a push. Now, Henson Trust, Lifetime Benefits Trust, Funding Trust with Insurance. I'm going to talk about insurance first. Well, no, I'm not. I'm going to talk about Henson Trust first. If you have a will with a trust of some sort, people ask me, well, does it have to say Henson Trust? No, it doesn't have to say Henson Trust. We, of course, always put Henson Trust in it so people can see that it's tomato soup. But instead of just a can of stuff that's red. But you have to have the wording. You have to have absolute and unfettered discretion and shall not vest. A Henson Trust can hold an unlimited amount of anything, money, houses, rental properties, stock. And there is no limit to the disbursements from the trust. Yes, it's true that you can give to the beneficiary up to $10,000 over 12 months, and that's all right. Yes, that's true. And further disbursements for disability-related expenses, yes, of course, that's right. But that's not enough, is it? Because this is a $300,000, $400,000, or $500,000 pension. It's generating $20,000 to $25,000 a year. Okay, we know you can give out 10 grand. What about the other 10 to 15? And why not? Why should a child not live suitable to their situation, frugally, appropriately? But why should they be limited? Well, they're not. So what happens is you can give them directly, if that's appropriate, up to $10,000 over 12 months. You can distribute from the trust money for disability-related things. Okay, there'll be cases where that's appropriate. But what about the rest of the money? Simplistically, the parents leave a letter of wishes to help give guidance to the trust. And the idea is to keep the child in the apartment, which the parents had always subsidized. So the rent for the apartment is $1,200 a month. It's a 2-bedroom. Or maybe it's really a nice 1-bedroom and that includes utilities and so on. But it's $1,200 a month. And the shelter component of ODSP is only $496, like $500. So what you do is the parents have always subsidized the $700 a month because, of course, they signed the lease anyway. So there was no problem with them paying that $700. Well, now they're deceased. How do you make sure that pension, that rent arrangement stays in place? How do you? I mean, the party signing the lease is deceased. Well, you have the trust or trustee sign the lease, or more likely, you have the child sign the lease, but the trust backs them up. And what you do, for example, to see that the money is dispersed, is it's $700 a month that is needed, so $8,400 a year on top of $10,000. And maybe you want to secure this whole situation for 3 years at a time. So that's $8,400 times 3, $25,000. So what you do is you pick a month, January, you disperse the 3 years worth of subsidy, $25,000. You pay it to the property manager and you tell them to take $700 a month for the next 3 years. Well, of course, they're happy. You don't have any problem with the child signing the lease when you've got a $24,000 down payment So everybody's happy. And when you do the annual disclosure to ODSP, you disclose the $25,000. And that's deemed to be a payment to the child. And in the month of January, you're deemed to have paid out, and the child is deemed to have received $25,000. Okay, so in the month of January, they were overpaid their ODSP. They received $1,169, and they're deemed to have been overpaid. Big deal. Because they received the $25,000, which prepaid the portion of the rent above which, well, above the $500 that they are obliged to pay to maintain this benefit from ODSP, but only that 1 month. So they've been overpaid $1,169. ODSP puts this on their monthly stub, and they then reduce their monthly benefits by $50 a month. And that's it. So $50 a month times, what's that? 24 months, let's say. That's about $1,200. So 2 years later, the $50 a month is removed. And if you were to do this each year, yes, each year there would be a 1 month overpayment, but there would always and only be a $50 reduction. So you can think of lots of scenarios where you disperse 25 grand a year, let's just say, every year. Well, every year you'd have an $1,169 overpayment, and you'd have a $50 a month recapture, which would never be affected. You'd never complete it. Because each year you're getting another overpayment, and you're only paying off $600 of the previous one. But so what? Any questions about that?
Not at this moment. Just want to know how the income of the Henson Trust was treated. If one's on ODSP, does the income from the trust count as income and the lower amount of ODSP received?
This is a common confusion. The ODSP definition of income is simply what is given to the child. It doesn't relate to what is income of the trust for Canada revenue tax purposes. So if you had a $100,000 trust invested at 3%, there'd be $3,000 income. But you want to give, let's just say, $5,000 a year to the child. Well, ODSP says there's been $5,000 of income, even though there's only $3,000 of true income. And similarly, if, for example, there was $3,000 of true income, but there were no disbursements, or say $1,000 disbursement from the trust, for ODSP purposes, the income portion would only be the $1,000 or nothing. As long as the income is retained in the trust, and of course with the Henson Trust you can retain any unlimited amount, but as long as it's retained, it's not income to the child, but it is income to the trust. So I presume that doesn't really make things clearer, but that's how it works. All right, let's see what else we've got here. Okay, let's just skip this. And skip this. Let's go to life insurance. So it's 8:15. I'll try to start wrapping things up shortly, and then we'll take more questions. With respect to life insurance is a way to make sure there's at least some money for the trust, and it's very economical. The trust would normally receive some share of an estate, but of course you can see lots of scenarios where there's not much in an estate, and there could be multiple children. There could be a modest estate and 5 kids. What do? Do you give each kid plus the Henson Trust an equal amount, like 40 grand? Do you give the child with special needs half of it, or a bequest of a big chunk, and then whatever's left, if any, is divided among the other 4 kids? You know, and do you do this in the context of those other 4 children, adults, of course, now, but those other 4 children who all throughout their lifetime saw their brother getting all the attention and the money, you know, spent on them, on that child. And, you know, frankly, at a sort of basic fundamental level, feeling that this is understandable, but somehow unfair. And having a family dynamic where it's unfortunate, but, you know, this is how it is, but somehow it just doesn't feel right somehow. So what happens is, especially if you're one of the 46,000 families that have the child at home, and they're bringing in $11.69 a month, if we've got the benefit, it's increased. You could buy life insurance to specifically fund the trust for the child. You could divide the estate equally to show that you love all the children equally, which you do, but that you need to fund the trust with some extra funding. Well, for example, just to look at this, if you're the mom and the wife is going to be the survivor in 2 cases out of 3, but suppose you're a mom, female, age 50, non-smoker, you have a life expectancy of 35 more years. And if you make it to 85, you have a further 7. The longer you live, the longer you're going to live. But actuarially at age 50, you have 35 more expected years. Well, if you had a universal life, a fixed premium policy, paying $100,000 on your death, the premium would be $115 a month, which is $1,384 annually. And it's a fixed premium. So if you were to divide the annual premium into the $100,000 payout, you can see it would take you 72 years to save $100,000 at the rate of the annual premium. But you're only going to live 35 more years. So you can see that from an investment, return on investment perspective, this is a good deal. Plus, if you die tomorrow, it's an even better deal in that sense. And this does fund the trust, and you know there's at least that amount. And of course, it could be any multiple of 100,000, and the numbers still all work just exactly the same. So you can see that if the annual premium is $1,384, and if the child is receiving $11.69 a month and is giving you $550 pursuant to this lease that I've prepared, that's $6,600 a year. Plus, you're saving $1,600 a year in taxes using the disability credit and $1,000 a year using the caregiver credit. So you're bringing in $6,600 of rent from the child to help pay this premium, plus your taxes are being reduced by $2,600. And of course, that $1,600 reduction for the disability credit is great because the annual contribution to the RDSP is $1,500. So it's a self-funding plan. So you can see here that if your plan is to just leave things equally to the children, you could fund the trust with life insurance. I apologize for the coughing. Now let's go back to what's called a lifetime benefits trust. This is a very interesting, unique vehicle. If you know someone, or you are someone, who has a sizable RIF for RRSP, and perhaps you have a spouse, and that RIF will pass over to your spouse, and perhaps they have a RIF too. So then one of them is, when you pass on your surviving spouse, your wife, she has more RIF assets. So then when she dies, of course, normally this RIF would fall into the estate. And yes, there are some exceptions. We can talk about that. But let's say that it falls into the estate. Then that half of it is lost in taxes. So here's the scenario. It's a $500,000 RIF. You die, or the surviving spouse. the estate pays 250 grand in taxes to Revenue Canada. Half. So your estate, your children get half, and the government gets half. Now, does that sound fair? Does that sound realistic as your expectations, all those years where you worked and didn't spend the money on yourself and saved it and tried to invest it at some reasonable rate of interest to help try to provide for your own old age? And turns out you did a great job and you lived frugally and you didn't spend it. And then you die and the government gets half. Well, this is going to be the scenario in many, many cases. It's going to, I don't know whether it'll pay our phenomenal deficit. Maybe it will. Maybe this will come to the aid of the government of Canada to pay for the deficit that has been accumulating over the last decades. Perhaps. I doubt it. But the plan here, the alternate plan, is to have a lifetime benefits trust and to designate this RIF to the trust. It's a separate trust parallel to the Henson Trust. The Henson Trust, the way I structure things, receives the share of the estate and perhaps life insurance. It could receive money left by a grandparent for that child. And then the LBT receives the registered funds, the RIF money. So it receives the $500,000 and it's received on a deferred basis, just like it would be to a spouse. So it's not taxed in the hands of the estate. It rolls over to the LBT, just like to a spouse, and there has to be an election. Thank you. There has to be an election, just like a spouse. But what happens is the trustee of this LBT, Lifetime Benefit Trust, can only do one thing. They buy a qualifying trust annuity based upon the expected lifespan of the beneficiary, the child, and it pays a certain amount per year, fixed for life or for a guaranteed period. And what we do is we determine what this payment's going to be, and in this case, based upon the child, the age of the child, their expected lifespan, and the amount of the RIF, it pays $24,000 a year. So the income, the annuity payment, is received by the trust and accumulated and then used for the child such that it doesn't affect ODSP. But the income, the $24,000, is phantom income directly attributed to the child. They don't get the money. They may get the benefit of it, but the income is declared in their hands automatically. And what we do is we set up a guarantee period, because this annuity is for the life of the child, or at least 20 years, because if you multiply 24,864 by 20 years, it gives you 500,000. So you get all your money back, no matter what happens, or somebody does. Because if the child dies prematurely, well, then this money is all commuted back into the hands of the trust and goes to the residuary beneficiaries, typically the siblings. Now you can see the tax savings here. This slide, Karen, make a reference. Have Christiane update this slide. The basic personal amount is now $12,000. The disability credit is now approximately $8,400, slightly more. But you can see that what this means is that 20,000 of the 24,864 is not taxed because it's covered by the personal credit and the disability credit of the beneficiary. Only 4,864 is taxed. And it's taxed 22%, the lowest marginal rate, which means taxes of 1,070. And over at least the 20-year guarantee period, the taxes are 21,401 versus 250,000. Now that's a plan. Oops, sorry. So you can see here that the savings are 228,000. That's something. And if you have a lesser RIF, say 275, taxes would be 137. Okay. Well, based upon the factor of how much is the RIF plus the age of the child at the time of death, you can see that the 2007 $275,000, if you had a 21-year guarantee period, would pay $13,200 a year for life or at least 21 years. It would be the $13,200 would be sheltered by, again, $20,000 of tax credits, which means that there's no tax payable. So there's no tax payable versus $137,500. Are there any questions about that?
I just have one question from a client that says, what are your recommended institution for setting up a lifetime benefit trust?
Well, the trust itself is set up just as per normal. It's a testamentary trust. You can pick any bank to, if you need a bank account to receive and disperse money. And you could set up an investment trust as well. It's all standard stuff. It's just the testamentary trust. The annuity itself would be purchased from a life insurance company. And what you would do is you'd shop around, find the best rate at that given moment. If the child happens to have disabilities that are going to reduce their lifespan, then you'd get a qualified annuity trust. That's not quite the right way to put that because of all the verbiage here, but based upon the child's life, if they're expected to have a lesser lifespan, you'd get a qualified annuity and you get more money for the child because their expected lifespan is shorter. And that would be with any insurance company. So it's not rocket science. It's just buying an annuity, basically. What are the situations where the caregiver credit cannot be claimed along with the disability credit? Well, if I'm reading this correctly, it's asking whether there's a situation where there's a conflict between using these two credits. There is no situation. Over the years, I've had people tell me that they've used one year and one the other year because they thought there was a conflict, or they thought that, well, the most common one is that they stopped using the disability credit when the child went into supported living because they thought they had to live with them. But there is no conflict. There is no situation where you can't use, if qualified, both the caregiver and the disability. And you can use the caregiver even if the disability credit is not available. It's not subject to the same approval process. The caregiver credit applies if the child is over 18, did reside with you, but now doesn't after 2017. They're over 18, and they have a disability, and you're a caregiver, which you are. And there's no real criteria that people say, well, how do I know? How do I qualify? All I can say is that if you are truly a caregiver, then you are a caregiver. And also, if the disability credit happens to be transferable to you because you help with the necessities, food, shelter, clothing, well, then clearly you are also a caregiver. All right, we're doing good. We're doing good. Let's see what else we've got here. Just some terms that you should be aware of. Qualifying disability trust. A few years ago, the rules were changed for testamentary trusts. It used to be that a testamentary trust, if it declared income in its own hands, that it would pay tax at the smallest, lowest marginal rate of 22%, which is very advantageous in lots of cases. So we did all sorts of multiple trust arrangements so that we had all these individual taxpayers at the lowest rate. But you can't do that anymore. All testamentary trusts are now, the income declared in the trust's hands is all taxed at the top marginal rate, 53% in Ontario, which is atrocious, right? Why? But anyway, so what you have to do, of course, is have the income attributed or declared in the hands of the beneficiary because they have $12,000 to $20,000 worth of personal tax credits, so that covers most trusts. If you had a $500,000 trust, and if it was invested at 4%, that's $20,000 income. So in that type of very common scenario, the $20,000 would be attributed to the beneficiary. They have $20,000 of tax credits, so no tax is owed. Graduated rate estates. There is a 3-year window. If you die, your estate trust can declare income in its own hands at the lowest rate for 3 years. Now, of course, paying tax at 22% is not better than having it attributed to the kids and not paying tax. It's just that it is lower than 53%. It's unfortunate that other Canadians with disabilities don't get this advantage, the disability tax credit advantage. The income from the trust, where the beneficiary qualifies for the disability credit, can use what's called a preferred beneficiary election. And you simply elect on the trust return and on the person's return, the beneficiary's return, to attribute the income of the trust to the child, the beneficiary, use their tax credits. And each year the trust return is a nil return, a zero return, because you've attributed all the T3 income into the hands of the beneficiary, so there's no tax owing, or less tax owing. And the other really unfortunate thing that was done a few years ago is that the federal government did away with the use of inter vivos trusts that we set up today to buy a home in which the child resides. Until several years ago, those homes would qualify for the principal residence capital gains exemption, just as if the home was in the name of the child. Because, of course, there's most circumstances where it's not appropriate to put the title into the name of the child. They could be not competent, and there's various reasons why you'd use a trust. And it used to be quite useful because if the trust owned a home and the beneficiary resided in the home, it qualified for the principal residence exemption that every other homeowner qualifies for. But the federal government, God bless them, decided to change that because of Vancouver and perhaps Toronto, but mostly Vancouver, where they decided that these trusts were being set up as resident trusts to get around the non-resident property purchase rules. Well, why can't you just say that you have to disclose or satisfy that the beneficiary of the trust is a Canadian resident, not a non-resident, and has a disability, or doesn't? Why should Canadians be stopped from setting up trusts to own homes for their children to live in? It protects against division of assets in the case of divorce, because if the trust owns the home, it's not a matrimonial home for the purposes of the child, the son or daughter, who gets married and then divorced. Why shouldn't we be able to do this? Why? Why? Why would you paint with such a broad brush to deal with some offshore problem affecting, what, 5% of all properties in Vancouver, but, okay, inflating the value of homes? Surely there's something better than this blunt instrument, which is much to the disadvantage of my clients' children. So that's my second rant for the day. Okay, questions. This is always the best part. So we have 42 people still taking part. And let's see what questions we have. Karen, do you think there's any good questions here?
This one here might be a complicated one, but it says, how can you possibly determine what will be left in a RIF upon death when you don't know when that will be or what the value will be, then as the value of the investments are variable?
Yeah, that's obviously the question. This is obviously an intelligent person. How can you tell for sure? Well, what you do is you look at your experience investment-wise. You look at how things have gone. And of course, if it's a RIF, you're probably in a relatively conservative investment mode. And then you can try to decide how long you're going to live. I have an actuarial table if you'd like a little assistance. And more to the point, really, you look at your present use of that RIF. Do you have other adequate income, investments, assets, pensions that you don't need to draw upon that RIF? Because clearly, I was talking to a client the other day, and she's a retired general practitioner doctor, and her main asset is her home in Toronto, and a RIF, which is not huge. It's $500,000, and it is her plan. She's now retired. It is her plan to draw upon that RIF. That was what it was for. Well, you know, when she passes on at her expected end of her life, there won't be much left. And so after we had this practical discussion, I gave her a breakdown of what the savings would be if she dies tomorrow. Could happen. And what the savings would be if she withdraws as planned. And at the end of her actuarial expectation, there's nothing left. Well, obviously, if there's nothing left, there's no sense doing it. But if you die tomorrow, there is. And you just have to make that call. Now, to tell you the truth, most of my clients that have done this have been in a scenario not like that. Not like where the plan is to draw upon it till you die. And I think in those cases, we should be confident that my client, the doctor, is going to live as long as needed, longer, hopefully, and that by the time she does pass on, that the RIF is exhausted. And from there, it becomes a matter of her personal peace of mind and her own, you know, vehemence as to not wanting to give half to the government, because if she dies tomorrow, she gives $250 to the government, right? So if you know, her own peace of mind and her own attitude towards the circumstances are such that she says, well, let's do it anyway. Well, we will. But in a lot of these scenarios, my clients that have adequate other income and a quite satisfactory RIF, like 1.2 million, the odds are good that they've made some good choices during their life. They might have got lucky, but I doubt that very many of these have inherited and 1.2 million and had 1.2 million of space left in their RRSP. I think that's really unlikely. It was interesting to me because the legislation, I've been following the LBT legislation since 2003. And long story short, it didn't get royal assent until 2013. Now, it would have still been effective. I looked into it. but it didn't really start, providing this service until after royal assent in 2013. And it's a complicated, specialized process. You're going to have to look a long ways before you find somebody else that has experience with these things. And it's largely because you have to have a clientele. I'm just sort of sitting back here and relaxing. I'm going to talk a bit and then we can all go home. But you have to have a clientele of my type, my special type, and enough of those clients, like 5,000, who would fit this criteria. Because otherwise you can't invest the time in coming up with the precedent and doing the research and twiggling as life goes by. And what I found was that when I explained how this all worked the first while, I thought it was fascinating because the clients wouldn't do it, much as they knew that they would one day die, and that when they died, unless they did something else, that half of their RIF of 1.2 million would go to the government. They knew those two certainties, but they wouldn't do it until I finally twigged to the fact that, there's these, typically with these annuities, you have a guarantee period. And you have a guarantee period that, satisfies the party putting the money into this annuity. But until I structured it so that we could guarantee with a guarantee period that all of the money put into this, at the very worst, would be returned with, the, as you see, the 20 or 21-year guarantee periods. People wouldn't do it. They were sufficiently astute that they just weren't prepared to let that loose end lie there. But then as soon as we built in this guarantee period, and it's not rocket science, you know, you do it anyway, but it's just that it was more finely tuned. Then people were prepared to proceed. And the most common profile is a person who has a sizable RIF, and they may draw upon it. It's true that once it's a RIF, you have to take certain percentages out each year. But that said, they have adequate other income or live modestly, live frugally. That's why they have their investments, because they made money in a previous life and they didn't spend it. They could have, obviously. So it's always a privilege to work with these clients, because someplace along the way, they or maybe their parents came up with this way of dealing with their lives that was a prudent, frugal way to deal with things. So it's always a privilege. Will a copy of the slides be sent? Yes. Everybody who's registered will receive an email with the PowerPoint slide set, as well as the link to the YouTube recording of this video. And you're free to pass it along. That's fine with me. Do you have any other questions that are of interest, Karen?
We've answered a few of them, and you've answered many. The last one that seems to be up on the board is what types of income are subject to the ODSP income test?
Yeah, what's happened here? That was an early question.
We kind of answered everything in your...
Where do all the other ones go? Just I'm right down to the bottom, and all I've got is these early four. Where'd they all go?
They've been answered.
Maybe. All right. Well, if you would you link Amelia back in, and she can say a few words, and we can all go home and have a cup of tea.
Hi, everybody. Thank you, Ken. Every time I join your webinars or watch the recorded ones on your website, I just think how grateful I am for your knowledge and experience. And
very kind.
I'm so thankful that we have partnerships like this, everybody, that, Ken has these wonderful strengths that I don't have myself. And so we know now, Ken, we can come to you and your team for this information anytime. And that we, like you said, are able to access the presentations and slides at any time. It makes it really accessible.
That's very kind. Thank you.
Well, you're very welcome. Much thanks from us here at Epilepsy Southeastern Ontario. And everybody for joining tonight. Thank you for bringing your questions about family members affected by epilepsy. You can always connect with us, like I mentioned earlier, through our website, www.epilepsyresource.org, and through our Facebook for more information, resources, and details about upcoming events. Speakers at our monthly group meetings, lots of different stuff going on monthly. So thank you, Ken, and everyone who joined tonight.